Welcome to Trading Nation. I'm Brian Sullivan. We're joined by Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, it's interesting because you say there's a sell signal out there that this time is not a sell signal, and that has to do with the bullishness of newsletter writers, which is usually a bad sign for stocks, but you say it's not now. How come?
Well, I wouldn't say it's a sell signal, Brian. I think it's just a sign that there's too much optimism. Like, there's a lot of commentary out this morning. The Investors Intelligence newsletter survey showed that 62% of newsletter writers were bullish, which is a pretty high number historically. It's only happened a couple of times during the last 7 or 8 years. And in both of those occurrences, you did have a little bit of a very brief pullback, but it wasn't anything to try and quote-unquote play or protect against. It was just you had a tiny pullback and then you ran to new highs again. And, you know, could that happen again this time? Definitely.
Yeah, and when you go to that, it's well, I think it used to be a contrarian signal, didn't it, Tony?
It did, and well. See,
so is it over? Is it gone? No. Can we still read about it in Barron's and whatever? You know, newsletter writers are too bullish.
You know, ultimately, it's like something that could be used as an excuse for, wow, that was a sign of the top, like a Time news, a Time cover or something like that. But all of these sentiment gauges only matter like in that 0.1%. Other than that, you know, the consensus is generally right. The point of the note that I had this morning in the two charts is that, you know, yes, sentiment is far too bullish historically, or is very high historically, but that doesn't necessarily mean the market's a sale. Ultimately, the market is a sale when the top is only defined as knowing that there's a recession in sight, and that only comes after an inversion of the yield curve and is shutting down a credit. So ultimately, that's really what I think the viewers have to determine is what defines a top, which means a temporary pullback, which we've seen any number of them this cycle, versus the top, which was a 2007, 2008 kind of top.
All right, Fed chair. The president making comments again today. I mean, heck, it could be Yellen again, although we got Powell and Warsh. Do you care? Does it matter for your clients about who the Fed chair is?
I seriously don't care.
Why
not even a little bit.
But, well,
look at it this way.
Let's
take a history of it. Back when Ben Bernanke, who was nicknamed Helicopter Ben because he was the dove that was going to be so super easy, he came in and raised rates 3 times in a row, ended up making the credit market shut down, did not ease quickly enough to get out of the financial crisis. I re-nicknamed him Submarine Ben at the time. And what ended up happening is he got the joke, and now I would build a statue for him because we ended up with quantitative easing and then Janet Yellen. But the point is, he was perceived to be the ultimate dove when he came in, but he wasn't. It all depends on what the data at the time looks like. It's not the Volcker era anymore, pre-Volcker, where the Fed chair had his decision and that was it. Now you have a very open and transparent Fed, so everybody gets a voice and they go by the data.
Are you confident in earnings? We've seen a lot of numbers already. They've been okay, but you know, in this market, don't you have to really outperform, not just outperform?
Well, sure you do. I mean, you have listen, the market is up 14% this year, and it's severely overbought, and there's too much optimism. That does define a point where you can have a pullback. But again, I think the market correlates most directly to the direction of earnings. That direction continues to be higher because the credit markets are still open, the yield curve is positively sloped, banks are lending. And here's the thing, Brian, that we've talked about on the last few shows. The headwinds that have held growth back in the U.S., which is 24% of global GDP, the headwinds that have held growth to 2 to 2.5% have become tailwinds. We have a synchronized global recovery, and now that's kind of like a Wall Street term, but it's been that way for almost a year. We have a weaker dollar. Even if on the little bit of a bounce we've had here, it's still a weaker dollar. We have a reacceleration of capital spending in the U.S. Business spending is going up. Household median income higher in 3 of the last 4 years than at any period during the 1990s. So you have tailwinds now. Oh, how about fiscal reform? That was something that's held growth back. Now we even have the prospect of corporate tax cuts, and we already know there's lesser regulation. So those 4 headwinds are tailwinds, and we do believe that at least for the near term, that's going to lead to what we're seeing, Brian, which is better than expected top-line growth, not just financial engineering earnings growth.
Yeah, watching the revenues. Sales, sales, sales. That's what matters. Tony Dwyer.
They don't lie.
No, they don't. They don't. Well, sometimes they might, but not usually unless somebody somebody's lying. Tony Dwyer
Right.
of Canaccord Genuity, thank you
Right.
as always, buddy. Appreciate your insight.
Anytime, Brian.
Thank
Thanks.
you. As always, folks, thanks for watching Trading Nation.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.